Hello and welcome back. You are watching Numbers and the Narrative. This is a new series wherein I take up a set of numbers relating to the economy. They might have been released by the government, private agencies, central bank, and I dive deep into these numbers to explore possible narratives. The narratives that could have been given by the government or the agency or the central bank which has released the numbers, and the possible alternative narratives that you must get to know. No prizes for guessing what we are going to take up today. Yes, trade data. The government yesterday, that is on Monday, released the latest trade data for the month of November, which showed that exports in November surged 19.4% year on year, raising hopes that the export story of India might be turning around. Not surprisingly, this morning's newspapers headlined it. And not surprisingly, they did so in a celebratory tone and with a predictable narrative. Exports defy Trump tariff. Fastest growth in 3+ years. November goods exports leap 19%. Trade gap shrinks to 5-month loan, etc., etc. Have things really changed for the good? Has India's exports story finally turned around? And if it is true, why did the rupee slip further in today's opening trade to another all-time low? Now, these are questions that beg a deeper examination of the data. And when we do that, the truth we find, as always, lies in the middle. For more on it, stay tuned. A gentle reminder, subscribe to our channel, share it with your friends, so what do we have from the government? The government said India's merchandise exports grew 19.38% in November compared to the same period a year ago. November, the exports totaled $38.13 billion compared to $31.94 billion last November. That's all very good. That number appears very impressive. Not until we compare it with what was happening in the previous month. Now, in last November, exports had actually slumped significantly from $39 billion in October 2024 to $31.94 billion. So it's a low base on which we are getting a very high year-on-year growth. But when we compare the November's number with the preceding month, that is October 2025, what is the growth we get? We get a 10.9% growth. In other words, month on month, export grew at half the pace that you would see when you look at the year-on-year growth number, which has made it to the headlines of all newspapers. So November is better than October, but it is not as spectacular as it is made out to be. If you look at the cumulative data for April-November period, what does it show? It shows that India's exports during the first 8 months of the current fiscal totaled about $292 billion, which is just a meager 2.6% higher than the $285 billion it totaled in the first 8 months of the last fiscal year. In other words, exports continue to be a painful story. November might be a bump that could be temporary in nature. More importantly, if we look at the growth number, and why do we say that it might be a temporary bump that may not be sustained, is when we dive deep into it. When we look at where is this growth coming from, as the Commerce Ministry itself noted in its statement, the growth is primarily driven by 5 categories: engineering goods, electronic goods, gems and jewelry, drugs and pharmaceuticals, and petroleum products. Beyond these 5 categories, there are as many as 30 main categories in which exports data is classified when they release it to the public outside. Most segments we see the performance is not so impressive, rather the performance continues to be worrying. Even within these 5 categories, the same pattern that we pointed out about the overall exports figure, which is you have a high year-on-year growth because the base last year was low, but when you compare November with October, that growth rate moderates significantly. This same pattern is also repeated in the case of these 5 industries, to which the government has highlighted as driving the exports growth. Sample this. Engineering goods, which account for almost 30% of India's exports, they registered a 23.9% year-on-year growth in November. But when you compare it with October, that number moderates to 17.6%. Similarly, for electronic goods, the year-on-year growth is a very impressive 38.9%. But month on month, it moderates almost to half of that, 19.2%. For gems and jewelry, year-on-year growth stands at 27.8%, but month on month, it's 15.8%. Drugs and pharmaceuticals, even a worse story. Year-on-year growth is 20.7%. Month on month, the change is just about 4.7%. Petroleum products are doing even worse. Compared to October, export of petroleum products were actually marginally down in November. But when we compare to November last year, we find 11.6% growth. In other words, in all these 5 categories, which the Commerce Ministry says drove the 19.38% growth that has been reported for the month of November, all these 5 categories, exports had significantly slumped in November last year. So you had a low base, and therefore you are getting a very high year-on-year growth. And based on this year-on-year growth number, therefore to conclude or to tend to believe that the export story is turning around could be highly misleading. Just to reiterate the point, out of the 30 main categories of exports for which we get the data, in as many as 13 categories, for the April-November period, there has either been no growth, almost no growth, or there has been a contraction. Some of these categories include farm goods such as rice, tobacco, oil seeds, and they also include labor-intensive export segments such as ready-made garments, cotton yarn, handmade fabric, handicraft, leather products, etc., etc. And that should be a matter of concern. Nonetheless, the performance of the engineering goods segment still offers us a silver lining. And it appears that a part of the resilience that we are seeing here could be because this sector has succeeded to some extent in diversifying its export destination. And if that is true, then they must be encouraged and supported. In fact, as we speak, the engineering goods export community has been urging the government to expeditiously implement a 25,000 crore rupees aid package it had promised. If officials in the government are watching our show, needless to say, the government must move on a war footing in this regard. Now, the other thing that the Commerce Ministry statement tried to highlight was how exports to US rose sharply in November despite Trump's 50% tariffs. It also pointed out to a significant surge in India's exports to China and a sustained high growth that we have seen in recent months in India's exports to Spain. Now, these numbers and inferring anything that suggests that we have a sustainable pattern there could be misleading. Why do I say so? Interestingly, with America, if you compare year on year, you get a growth rate of almost 22.6%. But like in the case of our overall exports, in November last year, exports to US had also slumped sharply. So therefore, there is a low base there and you are getting a very high growth rate of 22.6%. But when you compare exports to US in November with that in October, you get only a 10.7% growth. And where has this 10.7% growth come from? As we said, electronic goods rose very sharply during this period. They registered almost a 19% growth month on month and a 39% growth year on year. Almost 60% of electronic goods exports today are smartphones. And among smartphones, an overwhelming share is from the Apple. Apple assembles them here and exports them to US. Remember, when Trump levied the 50% tariff on Indian imports from India, he kept Apple's import of smartphones out of its purview. So import of smartphones do not invite the punitive tariff that other imports from India attract, which is where the catch lies. Now, this is something which may or may not be sustainable. Similarly, the ministry talks about China and how in recent months our exports to China are growing. By the way, both with the US, our imports have also significantly increased. In fact, increased at a faster rate than our exports to those countries. And the same is true of China as well. But interestingly, for China, why we do not need to feel excited? Exports to China in November nearly doubled compared to a year ago. But why did it double? Not because we succeeded in exporting a whole lot of value-added manufacturing products. It's primarily on account of iron ore exports. Now, of course, that's not something we are going to feel very comfortable about, right? That's not something which is again part of a sustained trend. Iron ore exports in November rose 178%. Understandably, much of that demand was from China. Now, when it comes to the US, remember in September and October, after the 50% tariff came into force, exports contracted in double digits. Now, with a deal between India and US increasingly appearing elusive, it's unlikely that in the months to come, we will see any change in the situation. The November positive growth, therefore, I would like to believe is a bump that is temporary. Unless we have this trade deal, things are not going to change. Indian exporters who are critically dependent on the American market, because that accounts for more than 20% of our exports go to America, Indian exporters will continue to feel the heat of Trump tariffs. To make it worse, Mexico last week announced that it was levying 50% tariff on all imports from countries with which it does not have a free trade agreement. Now, why is Mexico doing this? Because China and even India, these countries use Mexico as a rerouting destination. China exports large amount of goods to Mexico, and from there they get re-exported to the American market because US and Mexico, they have a free trade deal. Now, Donald Trump is very upset about it. And the free trade deal between Mexico and United States is coming up for a renewal in 2026. Mexico knows that it cannot afford to keep Trump unhappy. Either the deal runs the risk of not getting renewed or renewed on such terms and conditions that might turn out to be non-beneficial for Mexico. So, to preempt any adverse reaction from the United States, Mexico now has announced that it would levy 50% tariff on countries, imports from countries with which it does not have a free trade agreement. For the record, Mexico may say it is doing so to protect jobs, to protect the manufacturing sector of its own country, but the truth is it is doing so to preempt any adverse reaction from America. Now, how are we going to be affected? Mexico is a very important destination for our steel exports. Companies like Tata Steel do export a lot to Mexico, for our pharmaceutical exports, and also for our electronics exports. More importantly, Mexico is the third largest export destination for our passenger cars manufactured by in India. And it's about $1 billion in exports as far as passenger cars are concerned. So there are about $2 to $3 billion worth exports that are at risk there. And the government has said that they have escalated the matter at a diplomatic level, but the response has come too late. Mexico seems unperturbed and it seems firm on going ahead with this 50% tariff. The other thing the Commerce Minister's statement pointed out was that there has been a surge in exports to Spain. Yes. Exports to Spain in November rose 181%. They have been rising in recent months. If you take the April to November period, you'll find exports to Spain have increased 54%. But don't get excited about it. The rise is nothing but a rerouting of the Russian oil exports that some of our companies were doing to Europe. Earlier, these oil exports were getting into European markets through the Netherlands. After Trump raised a hue and cry about it, Netherlands stopped taking Russian oil that was coming from Indian companies through Rotterdam. And that is the reason why Netherlands, which was our third largest trading partner, exports have been declining steadily in recent months. And these oil exports that were earlier entering Europe through Netherlands are now entering through Spain, which is why you see a spike in the number for Spain. Even that spike to Spain has not been able to fully offset the decline we have seen vis-a-vis Netherlands. If you remember, I had done a video earlier saying how India's export story is faltering, where I had pointed out that with nearly half of its top 20 trading partners, in the first 6 months of the current fiscal, India's exports had contracted year on year. Things have improved a little bit. At that point in time, India's exports to 10 out of its 20 top destinations had contracted year on year. Today, if we take the November data, in other words, the first 8 months of this fiscal, you find still India's exports have contracted in the case of 8 destinations. Our exports to 8 of our top 20 destinations are still down year on year if we take the April-November period. Now, if this trend does not reverse, and given the fact that the India-US deal is nowhere near in sight, which means we are going to be having trouble with our export numbers to United States, more likely they are going to be down year on year, then FY 2025-26, we might end up having either no growth in exports or a contraction in exports for the full year, which will obviously have its consequences for the broader economy, because exports account for more than 20% of our GDP. And if you are not getting any growth in that segment, then it is difficult to visualize how India's economy could end up FY 25-26 with a growth rate, as the government is saying, close to 8%. That aspiration, that ambition appears to be far-fetched. And I think that is something not just me, but many others are also inclined to believe, which is why you saw, despite this headline number of 19.4% growth in November in exports, the markets didn't really cheer it. The rupee in opening trade slipped further to a new all-time low of 90.81. As we speak, we do not know if it is recovering ground, but the rupee continues to be under pressure, and our export story continues to be faltering. Thank you for watching this video. If you have liked our show, please spread the word, share the video, subscribe to my channel, and keep coming back. Thank you.